Hey everybody, back with another ETF review, and today we're going to be doing a bit of a re-review of the Schwab US Dividend Equity ETF, or SCHD. I think it's only fair that since I did make in my last video a quote-unquote better dividend ETF for the current environment from SCHD, it would only be fair to actually look at SCHD as a whole. Also, haven't taken a look at it in depth in almost a year, so it's good to stay, fresh and up to date. I do often use SCHD as kind of a gold standard for dividend appreciation ETFs, as it has done well over its existence, but let's go back and look at it again and see if it is still holding up. Starting with the expense ratio, very low, 0.06%, about as low as you're going to get from any kind of passively managed fund. There are a few that are, one or two hundredths of a percent lower, but this is really the cream of the crop when it comes to expense ratios. So what is the fund? Looking at the objective, its goal is to track as closely as possible the Dow Jones US Dividend 100 index, which is essentially an index of companies that have very good payout ratios, relatively good balance sheets. They're raising their dividends. They're companies that are financially stable, that are able to sustain their dividends and have quality dividends, as we can see here. Looking at the current yield, it's currently sitting right at about 2.7, 2.8%. If we look over here, there we go, 2.78% on the distribution yield for the trailing 12 months. So, nothing crazy, but doing better than about right around twice what the S&P is giving you. So not bad there. Looking at that actual yield going into the distributions, we can see that the distributions have been increasing quarter over quarter and year over year. As I said before about a year ago, you do have to be careful with these distributions, as because it's an ETF, the way that the distributions come out are based on the companies. As you can see here, the last, four distributions for 2021 were all increases, but from 2020 to the first of 2021 there is a decrease. That's very likely going to happen again. The first payout of 2021 is going to be likely less than this 62 cents we're seeing here, but likely and hopefully more than the 50 cents we're seeing for March of 2021. So just keep that in mind, that that's very likely to occur going forward. Just how the calendar year works, those are how the distributions should kind of work out for you. Going back to the fund as a whole, it is a very large fund. Currently sits at about $32 billion, $32.5 billion in assets. So this is a very large fund. There's a lot of liquidity here, a lot of investors, a lot of shares outstanding, almost 400 million. You're going to be able to trade this if you want to do so. Next, let's actually take a look at the holdings here, the entire portfolio. You're going to see companies that names you know, household names: Coca-Cola, Cisco, Pfizer, Verizon, Pepsi, stuff like that. All of these companies, almost all I should say, are very large, in some cases mega cap companies, so bankruptcies really shouldn't be a big issue, thinking about huge destruction of the fund in any way. We can see here that the percent goes in the top 10 from about 4% down to about 3.5%. It does vary wildly once you get into the full holdings, going from 4%, where there are a couple of holdings that have well under 1% or are barely held. So keep that in mind. This isn't an equal weight fund by any means. Looking at the allocations, as I said with the market cap, many of these companies are massive companies. Most are, or a very large amount are in the S&P 500. There are a few small companies and there are a few small caps. Sturm Ruger, for example, is held, but mostly these are very large companies, many in the S&P 500, as I said. Looking at the sectors, we can see that financials and information technology take up a huge portion, making up, 43+% of the portfolio. That is a bit of an issue, especially in the current environment. As I said, with rising interest rates, those are two sectors that should take relatively large hits, especially information technology, because that sector runs on debt. With financials, it's a little bit harder to think of, a little harder to really parse out. While they should be able to get less loans because of interest rates, the loans that they do get will be at higher rates. So, scale, give and take there. Going down, we see consumer staples is a nice allocation with about 14%, industrials about the same, in healthcare. Then we get down, energy barely, materials barely, communication a little bit, mostly Verizon in that regard. So there is some diversification here. It's not crazy. You're not getting two sectors making up over half of the fund. Two sectors do make almost half of the fund, but there is a good bit of diversification. Just be careful of those top two with the current environment we're in. It's something to think about, something to look at when you go forward. Looking at performance, we can see that over the past, few years, it's done very well. Since its inception back in the early 2010s, it's done 15% a year, which is great, well outpacing the average of the S&P over time that sits about 9 to 10%. We can see that over the last 3 years and the last year, it's been doing 20 to 30%, which is, again, very, very good. Now we can actually look at some back tests to see just how well it did. In our first back test, we will of course have SCHD being itself. We'll put that up against Vanguard's Dividend Appreciation ETF, something of a competitor ETF, as well as the S&P 500, which will be our control, using VOO from Vanguard for that. As we can see, there's not a huge amount of discrepancy here. All three funds have done well through this bull market. We can see that the S&P 500 has outpaced a little bit, doing about, what are we looking at here? About 1% better a year, 1.2% better a year, which is, nothing to laugh at over, a 10-year period. That's very good, but it's not crazy. We can see, however, that the SCHD did outperform its competitor in the Vanguard Dividend Appreciation ETF by a good bit, about 1% there. One thing to note is it did have a larger drawdown than the wide market, and its worst year was worse. However, its best year was also better. So, some give and take there. Just note that you're doing about as good as the market, a little bit less, which you should keep in mind if you care about total return. However, if you are a dividend investor, if you're an income investor, being able to trade off a little bit of that total return in order to get some income could be more important for you. Just keep that in mind depending on your investment strategy. Going to our second back test, this will be purely against competitors. We'll again have SCHD put up against NOBL, which is the ProShares Dividend Aristocrats from the S&P 500 ETF, and the Wisdom Tree US Quality Dividend Growth ETF, both dividend growth ETFs themselves. As we can see here, SCHD does lead the pack, albeit only slightly over the Wisdom Tree fund. The ProShares fund does do quite a bit worse. As we can see, the compounded annual return is more than 1% less, and it also has the worst drawdown. So again, SCHD right neck and neck with its ProShares, just barely edging it out, but again, doing very well in its sector. One of the best dividend appreciation, quality dividend ETFs that we have out there. So, looking on from a year past, is this still something you want to look at? Again, the sector thing is a bit of an issue looking at the inflation environment. However, it is something to note that I did go through a large amount of the companies, not quite all of them, but the majority of them, and they do have good balance sheets for the most part. Most have, more long-term assets than long-term liabilities, and more short-term assets than short-term liabilities. Most also have very good cash flow coverage, with some of them down there in the 20-ish%, and most being well under our acceptable 75% payout ratio. Some are on the decreasing cash flow, decreasing income side, but it is not the majority of the fund. So most of these companies are resilient. Most of them are very old companies, decades, some over a century old. So keep that in mind as well. So should you be looking at this? Is this a fund that you, if you still have, you still want to have, or if you don't have, you should be looking at? If you're on the dividend appreciation side, this is probably your core holding. You're going to probably choose one of these ETFs, like from the 4 dividend appreciation ETFs that we've looked at. SCHD would likely be a core equity holding in your portfolio. You're going to get dividend appreciation from this, barring some massive market shakeup that's where dividends just stop growing completely. This would be, something to look at as a core holding in an appreciation portfolio. If you're in an income portfolio, currently just under 3% isn't crazy. It still might be something you look at, especially as a stabilizing force. If you have a lot of small caps with high dividend payouts, or you have a lot of, option strategy ETFs, high yield bond ETFs, stuff like that, this could be a stabilizing force in that portfolio. The companies in here, they're very stable. If you just plan on holding it forever, this isn't a fund that's going to go to zero unless something crazy happens. The U.S. government falls apart, the economy falls apart, something like that. This will continue to exist. The companies in here, the vast majority, are very stable, very safe companies that over long periods of time should get you a good return. Going into that a little bit more, we can see that the PE of the fund, granted this was back in September, so now it might be even a little bit lower, is under 17. That's right around the average for the S&P for its existence, whereas it's currently a little bit over that. Price to free cash flow also very good, still probably even lower than that now. Return on equity amazing at 31 almost %. yeah, it's a very stable, relatively safe fund. If you're looking for growth, obviously this isn't for you. Growth's going to outpace this in a bull market. But, in a down market, in a flat market, something like this, if you are a dividend investor, is definitely something to look at as a core holding or as a stabilizing force, as I said before. So yeah, looking on a year, it's about the same. I mean, personally, I think the market's overpriced, but that's just me. But if this is something you're looking to, dollar cost average into, and you don't care about an over or underpriced market, I think this is probably a very good choice when it comes to dividend appreciation, quality dividend ETFs. Again, I still think this is the cream of the crop. I'll probably still be using it as my control against other dividend ETFs just to see how they stack up. So yeah, as always, thanks for watching, and I will see you next time.